we're going to look at now why dividends are actually even paid by companies. So there's two sides of the argument on whether it even makes sense to pay a dividend to shareholders or whether you shouldn't. So let's look at the pros first on what are the benefits of being an investor in a company that actually pays dividends. And there's a couple of things that investors like. First of all, it's a good signal for investors. What it basically means is a company is saying we're generating consistent profits, we have a lot of cash flow, and we're growing, and we're going to give some of these profits back to you as the shareholders in the form of a cash payment. So it gives you a sense of comfort that this is not a company that is in financial trouble and they're continuing to grow. Um, the second thing is that the dividend paying companies generally do better in terms of their share price growth in the long run. So it may seem counterintuitive because you're paying out a dividend rather than reinvesting it. But if you look at companies that pay dividends and compare them to companies that don't, the long-term share price history is better for companies that actually do pay dividends, as a general rule. Okay, so what are the cons or the arguments against paying out a dividend? The first one is that you're giving away cash that's inside the company, and companies put a lot of effort into getting cash. External financing is you borrow money or you issue shares, but in this case, you're giving it away forever. The second thing is, as a result of this, there's the opportunity cost of not reinvesting the money. You could have reinvested and grown the shares more, or you could have bought back shares of the company or repaid debt or things like that. Okay, so all of those seem to be intuitively good things to do: paying off debt, reducing, share equity, or reinvesting the company. And the last thing is from a shareholder perspective. The very first video we did in dividends is that you're creating a taxable event for shareholders. When they receive this cash dividend, they may be happy and it may make them feel good to have the cash sitting in their account, but they're going to need to pay taxes on it. But if it was left and reinvested in the corporation, you wouldn't pay taxes till much later when you sell the shares, and the tax rate for capital gains would in Canada is lower than it is for dividends. Now let's consider why do dividend paying companies do better than companies that don't pay dividend. It's counterintuitive. You would assume that companies not giving away the cash would do better. But the first reason is just the segment of the population that you're looking at. Dividend paying companies tend to be larger and safer companies, which is why they chose to pay out dividends. It's excess cash. So if you compare them to smaller, riskier companies, you would expect them to do better. The second thing is the expectation of a dividend puts very specific pressures on managers to meet their earnings and to grow them, because you also want the dividends to grow in the long run. So that added pressure puts more focus on managers to do the right thing. Okay? And if they didn't have that pressure, they'd still work, but maybe not to that level. And the third thing is that you have a situation where managers are not given as much resources. So there's a limit to it. If you gave them unlimited resources, they would be more likely to do investments that are more frivolous or less profitable than some of the other ones.